I talk about and review various funds, especially covered call funds, all the time on this channel. And to be honest, it's really the content that I love doing the most. I pretty much know all these funds by heart and own many of them myself for years. So I feel very comfortable and confident in reviewing them and sharing my thoughts on them with all of you. So I decided to start a new series where I review all of my favorite fund managers who have covered call funds or split share funds really designed for passive income investors like myself. So the first fund manager I want to review in this video is BMO. BMO is the biggest covered call fund manager here in Canada by far in terms of AUM or assets under management. So their covered call funds are very popular. They're very well known here in Canada. You have funds like ZWC, ZWB, ZWU, etc., etc. So in this video, I will review and go over all of my favorite BMO ETFs. Obviously, I will focus on the covered call ones, but I'll also quickly go over their other ETFs to tell you which ones I think you could consider or I think that are interesting if you're maybe not an income investor like I am, but you're a growth investor or a dividend growth investor or even a very conservative investor. So at the end of the video as well, I have a special and exciting announcement regarding BMO and a future collaboration I'm going to be doing with them shortly. Most of you already know what's coming up, but if you don't, it's pretty exciting stuff, especially if you invest in any of these BMO ETFs, right? So you don't want to miss it. Stay tuned until the end of the video for that. So let's get to it right away. All right, let's do this, everyone. So I am on the product list, on the ETFs product list for BMO. This is the entire list of every single BMO ETF out there. And I'm actually going to run through all of them, but I really want to focus on the covered call one. So the ones at the top are really the fixed income ones, which are kind of yucky. I hate fixed income, but I will go through them very, very quickly later on. But I really want to focus on the covered call ones. And those are under the category specialty income. I just love the sound of that. So before I go through all of them, I think it's very valid that I want to review with you guys very quickly a BMO strategy or their covered call strategy, right? Because it's very unique. Every fund manager has a different covered call strategy. So in short, BMO sells out of the money OTM call options on 50% of the stocks. So that right there tells you the two most important things when you're trying to look up what kind of a covered call strategy is. Are they out of the money or are they at the money? So out of the money means they're less aggressive and it gives you room for growth. At the money, very aggressive. There is no room for growth, but the premiums are higher, right? The more aggressive it is. And the second thing is on the coverage of the portfolio. Is that on do they write covered calls on half of it, on a quarter of it, on a third of it? Well, it's 50%. So for BMO. For BMO ETFs, option expiries are generally 1 to 2 months. So they're very short covered calls. And you have some more details here. Out of the money call options are sold on approximately 50% of the portfolio, depending on market conditions. So there could be a little variance there. This gives the investor an enhanced yield and still allows for participation in rising markets. So the selection of the options strike price will depend on the available option premiums and general economic conditions. We sell further out of the money when volatility rises and closer to the money when volatility drops. When volatility rises, the option increases in price, right? So whenever the stock market starts going bananas, higher volatility, it just means option premiums are higher. The option increases in price. So the BMO, in short, the BMO covered call strategy strikes a balance between generating income and participating in rising markets. This approach can potentially provide exposure to the underlying portfolio, which means, you're still holding the stocks in the portfolio, so you're capturing that growth as well. Obviously less because of the covered calls, right? But with significantly less risk. As we know, the covered call strategy is actually a very conservative, defensive strategy. So let's go through the covered call ETFs or the specialty income ETFs. As you could see, I really like this. They put the ETF objective is defensive income equity. I always found that very interesting. They say defensive because covered call strategy, guys, is a very defensive strategy. So let's go through all of these guys one by one, all of these ETFs here. So the first one is ZWC. This is one of the most popular one. You will have all the best Canadian dividend stocks in here. That's why it's called the BMO Canadian High Dividend Covered Call ETF. So dividend stocks with covered calls. Very big fund, 1.3 billion. So a humongous fund here. And the annual management fees are pretty much all 0.65%. So they're very, very low in terms of covered call ETFs in Canada. Some of them are 0.65, some of them are 0.75, 0.85. So BMO is actually on the lower end, and you actually have the MER here, which is the full management fee, including all costs and everything like that. So it's slightly higher at 0.72. But just don't forget that, guys, that management fees, the MER, is net. Distributions are net of this management fee. So it's not like you're paying your a management fee out of your account. Think of it like it's included in the fund. So ZWC has a risk rating of medium. They pretty much all have a risk rating of medium, except for, there's a couple of exceptions. And if you go to holdings, you will see what this fund actually holds. The most important thing when you're trying to determine what ETF you want to invest in, guys, is always what's inside the fund. So you really have the best Canadian dividend stocks here. If you just click on sector, you'll actually see the sector. So CIBC, Royal Bank of Canada, Bank of Nova Scotia, TD, Bell, Enbridge, CNR, Manulife, TELUS. I mean, all the classic best Canadian dividend stocks, everyone, is in this fund. So this is really the best dividend stocks in Canada. A nice mishmash. If you go all the way down, you will see the sector allocation. Obviously, it's Canada, right? 100% Canada, which means very heavy on the financials, very heavy on the energy, and barely any, or actually no, healthcare and technology. That stuff is not in Canada. That's all in the US. Second one, ZWB. This is actually their biggest one at 2.6 billion. Humongous fund. And it's like the name says, it's just the 6 Canadian banks in here. So, these are some of the best banks in the world. Very, very nice yield at 5.53%. It's nothing crazy. Keep in mind that these are covered call ETFs, guys. They're not leveraged funds, right? There's no leverage here. So they're more conservative compared to a split fund or a closed-end fund. So ZWB. Also keep in mind, ZWB is one of the 7 funds in HDIV, a really, really good covered call ETF from Hamilton that has a collection of covered call ETFs. One of my favorite new funds, definitely the best new fund of the year for 2021 in my opinion. So ZWB is one of them in there. Next, you have ZWK, which is just the US banks version of ZWB. So this is the best US banks in here. Does have a risk rating of high because it's very concentrated, and the US banks are a little bit more volatile than the Canadian banks. So if you just go to holdings, you'll see the banks, all the banks that are in this. I mean, you'll recognize a lot of them if you know the US banks. You have Wells Fargo is a big one, Bank of America, US Bancorp, JP Morgan and Chase, that's the biggest one, I believe. Of course, the legendary Goldman Sachs, the legendary Citigroup. So all the best banks here. Next is ZWT, their technology covered call ETF. So this is a rather new one that they came out with very, very recently. I think it was in 2021. Yeah, 2021. So this is, like the name says, all technology companies. The yield is a little bit low at 4.38, but keep in mind technology companies typically don't have big dividends, so that's why. So in here you have all the best technology companies. You'll recognize all of them: Apple, Google, Microsoft, Amazon, Nvidia, Meta, which is Facebook, Visa, MasterCard, which I like putting in the technology here, the credit card companies, Cisco, network stuff, Adobe software, Accenture is IT services, Netflix, Broadcom, network stuff, Salesforce, PayPal, etc., etc., etc. So you have really, Shopify is even there. You have not only the software companies, you have the chip makers as well. So here's your technology one. ZWU, one of my favorite ones, definitely also another big one, 1.4 billion. The best utilities companies in North America. And as we know, utilities, which consists of utilities, which is electricity, telecommunications, so telecom companies like Bell and AT&T, and as well as pipeline companies, they're very defensive. This is why the risk rating is actually low, but it's actually, believe it or not, has the highest yield of all the covered call ETFs right now. So one cool thing about these the utility sector is that the dividends are really good. So in the holdings, you have a lot of of the best utilities companies. You have Rogers, TC Energy, which is pipeline, Bell, we all know what Bell is, Enbridge, another pipeline company, Pembina Pipeline. So TC Energy, Enbridge, Pembina Pipeline are the three biggest pipeline companies in Canada. You have TELUS, Bell, and Rogers are the three biggest telecom in Canada, but you also have the US ones as well as electricity companies. So Fortis for electricity, PPL, Southern Coal, Duke, Exelon. These are the US ones here. Verizon, AT&T, US, a couple more electricity companies. So really the best of the best when it comes to utilities in North America. I really, really like this one. ZWA is one that I don't have. This is very interesting. It follows the Dow Jones Industrial Average Index. So if you didn't know that, what the Dow Jones is, it's a very popular index that measures US stocks, just like the S&P 500, but instead of 500 companies, I believe it's 30 companies. So you have basically the 30 most important companies in the US. The yield's fairly low at 4.37, but the quality, is incredible here. You have the biggest blue chips or the most important companies in the US here, all kinds of sectors. So, Goldman Sachs, United Health Group, Home Depot, Microsoft, McDonald's, Caterpillar, Visa, 3M, Apple, American Express, really the king blue chips in the US. ZWH is ZWC's counterpart, but in the US. So ZWC is Canadian dividend stocks. ZWH is the American stock. So you have the best American companies in here. So I would actually, instead of getting ZWA, I prefer this one because the yield is a little bit higher and you have pretty much the same type of companies, right? All the best American companies. And, I'm not going to show it to you every time because I don't want to make a 1 hour video, but if you go to holdings and scroll down for each and every one of these, you'll see the sector allocation and the geographic allocation. And by the way, that document, that covered call document I showed you, it's available here at the end of every covered call ETF if you want to click on it and read more on that. So that's ZWH, and keep in mind they have a currency hedged version and a non-currency hedged version, right? So ZWH is non-currency hedge, and then you have ZWS, which is currency hedge, which means that any fluctuations between the Canadian dollar and the US dollar on the hedged one will not affect the ETF. But to be honest with you, between the two, I would just go with the one that has the higher yield, which right now is the non-hedged one, as simple as that. And they even have a US currency one as well. The .Us are .Us. There's a few of them that have a US currency if ever you're interested in that, if you have US dollars. So moving on, let's see, where were we? The Europe one. So ZWP is the Europe dividend one. So ZWC is Canada, S and H is US, and then you have ZWP and ZWE for Europe. P is the non-hedged and E is the hedged one. So once again, the best dividend stocks, but this time in Europe. So if you go to the holdings and go on sector, you'll see all the companies, really all the best dividend stocks in Europe, all over Europe, by the way. So maybe a lot of these companies you won't recognize. I recognize a few of them and not all of them. I know Alliance is Switzerland. I think it's an insurance company. Total Energies is the biggest energy producer in France. GlaxoSmith is healthcare, I believe, in England. Novartis, another healthcare. Unilever, this is like the Procter and Gamble of Europe. NL is in Italy, energy company. Nestle, we all know what Nestle does. Even Louis Vuitton is here. Hennessy, consumer discretionary. Volkswagen. So really the best and biggest dividend companies in Europe. ZWG, this is one of my favorite ones as well, along with ZWU, one I really like because it's literally the BMO Global High Dividend Covered Call ETF. And just before, I wanted to show you that the breakdown that you have all the countries in Europe here: Switzerland, Germany, United, UK, France, Italy, Finland. So really, really nice European exposure. But GDV has everything. It has the best companies all around the world. So think of it like a combination of ZWC, ZWH, and ZWP together. So it actually has more companies too. It has 50 companies instead of the usual 35 and those other ones. So I won't go through them, but really a mishmash of the best. Very, very, very well diversified. So you have sector diversification and also geographic allocation diversification here. So you have US, you have UK, you have Canada, Japan, Australia. So obviously very heavy on the US because that's just where the best blue chip companies are. But this is really global dividend stocks. So if you ask my opinion, which one is the most important one to have in your portfolio, it's ZWG because it's really the most diversified. Now we come down to the special ones that they have that are not necessarily covered call ETFs, but they use options in a certain way, but it's what I like to call safety ETFs. So they don't hold much stocks. ZPay does hold some stocks. You could see the holdings here. And what they do is they write covered calls and puts to generate premiums. So you could see what kind of companies they hold here. And if you look at the bottom, most of this ETF and the one next that I'm going to show you, the biggest holding is really cash. So these are a little bit less correlated to the stock market. This is why I tell people that they're really good for safety ETFs. So, you know, if the stock market drops 30%, something like this will drop maybe 10% just because it holds mostly cash. And you could see that even in the risk rating, it's low to medium compared to medium like the rest. So a nice 6% yield with ZPay. I really like this one. It does puts and covered calls. And then the other one is the put right ETF. So ZPW or ZPH is the hedged version. That this is the one that's my preference because the yield is a bit higher. It's at a little over 7, still a low to medium, but this one literally holds nothing. They write put options. So most of the holdings is cash. So the holdings that they have here are literally the ones where the put options were exercised. So they got stuck with these stocks. So I'm not going to go through it here, but if you want, you could actually click on this document to know what their put right strategy is on this ETF. But if I remember correctly, they're allowed keeping the stocks for 2 to 3 months and then they resell them to get rid of them. And they just keep continuously writing put options on a basket of US stocks. So there you have it, everyone. I got through it. These are all of BMO's covered call ETFs, or the last two are, you know, the ones that use option strategies. So here they are. Now let's just go back to the entire ETF list, and I'll quickly go through all of them and really advise you guys if I feel there's one that's very useful, you know, for either growth investing or dividend investing as well. So let's go through the list. So we're starting with the fixed income ones. All yucky if you ask me. Nothing special really. So you have this one. Okay, ZAG is really the lowest risk ETF that I've ever pretty much found that has 3% yield. So if you're someone who is really, really, really scared, really conservative, and even ZPay and ZPH or ZPW is not your cup of tea, you still think that's risky, you really cannot take any volatility whatsoever, please do not leave your money in the bank. Please do not put them in GICs doing nothing. At least at the bare bone minimum, put them in something like ZAG, which is just a collection of, I believe it's government bonds. So very, very, very boring stuff, but you'll at least get 3%. So BMO has a really big collection of fixed income. So you have all kinds of fixed income here. So I'm not going to go through each of them. Like I said, ZAG is probably one of the best ones. It's also a very, very big one as well. As you could see, that the management fee is pretty much peanuts. Ultra short ones. Then you have ones that are specifically government, the government sector. So you have the federal, you have the there's even a provincial one, and et cetera, et cetera, et cetera. There's a long provincial one. And in my opinion, I would never invest in any of these mortgage-backed securities. No, that's only 1%. They in the corporate bonds are a little bit more interesting than the government bonds. So the yields are a little bit higher. The one that really I think is the only one worth mentioning is the BMO high yield US corporate bond one. So you have a hedged version ZHY in a non-hedge version ZJK. And as you could see, decent yield at a little bit over 5. So these are pretty much the only ones I would really consider, and it's actually part of my ZJK, I believe, or ZHY. I can't remember which one I put, but it's part of my low risk income sample portfolio in my digital product. So besides that, let's see what else you have. They have preferred shares. So you have ZPR for Canadian preferred shares, kind of in between equity or stocks and fixed income. So preferred shares is kind of like shares, but it's kind of like a bond. It's like a hybrid. So very conservative stuff here. Low. They all have low to medium risk ratings, by the way. So you have your ZPR for the Canadian ones, and then you have your ZUP and ZHP for the US ones. Obviously, the US one's always a little bit higher, but if you're considering the preferred shares, personally, I rather go with the corporate bonds. My opinion. Then you have some classic. Now we're into the equity section. Oh, crap. Come on. The equity section. So this is where it covers stocks. So you have some generalized ones that they called conservative, balanced ESG, growth, and even one called the BMO monthly income ETF. I always thought that was interesting, but then I looked inside and it wasn't really that interesting. It's really a collection of a mishmash of a bunch of ETFs in there, including some bonds, including some regular dividend ETFs, including some covered call ETFs even, but it's only 3.83, so not very interesting to me, honestly. The specialty income, we already went through all of them, so let's continue. Now we have the Canadian market ones. So you have your popular Canadian index fund. So Vanguard, by the way, guys, is not the only fund manager who has your core or your typical passive growth index ETFs. BMO has all of them as well. So you have ZCN here for your classic S&P TSX capped, which means it's like buying the whole Canadian stock market. So this would be the equivalent to the S&P 500 on the US market. This is basically the same thing on the Canadian market. It's like buying the whole Canadian market. ZDV is the best Canadian dividend stocks without the covered calls. So it's basically ZWC without the covered call. So obviously the yield is going to be lower. It's not going to be 6.5. What's the current 6.33. So you're not going to get 6.33. You're not going to get the covered calls, but you'll get all the best dividend stocks here, and you'll get the organic growth of it as well. So this is for a dividend growth investor. Low volatility one, not that interesting. Then you have the US market. So of course they have their own S&P 500 one. So this would be identical to VFV. Maybe the MERS a tiny bit higher, but there's your S&P 500 one. You have a hedged one, the non-hedged one, and you have a bunch of other ones for the US. You have a mid cap, which means it's medium-sized companies. Small cap for the small company. So these are really all growth oriented index funds pretty much. Here's the Dow Jones one. So this is the non-covered call version of ZWA like we saw earlier. You even have the NASDAQ one, right? The NASDAQ 100. So QYLD without the covered calls. You could see the massive, there's basically no yield, but this is what will capture your there's a lot of technology company in here. That's why it says diversified technology equity, but it's not only technology. So this is your classic, what is it? XQQ, I believe, or VQQ, whatever it is. It's just ZQQ. Yeah, so BMO, everything starts with Z. And they have a couple of other ones. They have this one is worth mentioning. This is the US dividend one. So it's ZWS or Z, what's the, I think it's ZH, ZWH. Yeah, so ZWH, ZWS, same thing, but without the covered call. So if you want this is once again for dividend growth investors. You have a couple of other ones. Let's see, what's active equity. I looked through these. I didn't really see anything interesting. This one sounded interesting, the BMO Tactical Dividend ETF Fund, but I looked at it. For pretty high management fee. It's just basically a collection of BMO's dividend and covered call funds. So not very interesting because you're paying a high management fee, but you're not really getting the yield, in my opinion. Then you have a section for global and emerging markets. So that we have Canada, we have the US. This is a global and emerging market. Once again, nothing really interesting here. All growth index oriented. There is an international dividend one. Where is it? Right here. So this is going to be your for dividend stocks internationally. So no Canada, no US here. So everything in Europe, Australia, Japan, etc. So 3.77. Once again, a good one if you're a dividend growth investors. You could get the Canada one, the US one, and this one here. Of course, for each one, keep in mind they have a hedged and non-hedged. I would just go with the one that has a higher yield, to be honest with you. And we keep going. They have a Europe one, one specifically for emerging markets. They always keep coming out with new ones. You have one for India, one for China, with a little bit of yield. So all passive index growth stuff. A couple more for the Canadian sector specifically. You have the equal weighted banks, ZEB. So this would be ZWB without the covered calls. You have one for oil and gas. You have one for utilities, ZUT. So this is ZWU without the covered calls. Here's the REITs one. So this does the same thing that XRE from iShares and VRE from Vanguard does. This is just the BMO XRE version. So it's all the biggest REITs in Canada as an index. So the yield's pretty good because REITs give a yield, right? 3.87. But if you ask me, nothing will ever beat RS, the middle field split fund, when it comes to real estate. You even have one for industrials. I hate the industrial sector. That's all the businesses that are very, very hard and usually that struggle. Aerospace, anything to do with manufacturing is in industrials. You have some for the US sector as well. You have healthcare. You have the equal weighted bank. So this would be ZWK without the covered calls. Global sector, a bunch of stuff here. Nothing really interesting if you ask me. There is a staples one. So getting consumer, just an ETF that holds only consumer staples, which is like grocery stores and Costco and Coca-Cola, stuff like that. So it's the consumer staples is also called the consumer, not the discretionary. That's the one that's not staples, but I can't think of that. I'm drawing a blank right now. Consumer defensive. That's it. Consumer defensive. It's also called that. And they have a junior gold index. That's the last one. So there you have it, everyone. These are all the BMO ETFs. Obviously, I spent a lot more time on the covered call ones, which are under the specialty income umbrella. But to be honest with you, BMO is an excellent ETF provider. I think it's the biggest one out of the 6 big banks in Canada. You pretty much have an ETF for all your needs, whether it's growth investing, whether it's dividend growth, whether it's the covered call, whether it's specific niche stuff. And they also have a lot of fixed income as well. So it's time for that special and exciting announcement I talked about in the intro of the video. Some of you guys already know this because I kind of already announced it in our Facebook group. So next week, I have the privilege of interviewing Danielle Neziol, Senior VP at BMO ETFs, as well as Chris Heeks, Portfolio Manager at BMO. So I will be asking them a bunch of questions on their covered call ETFs, and I will not hold back on the hard questions as well. This is exciting because these two people are literally the people who manage the covered call ETFs and actually write the covered calls every month and decide what the monthly distributions are, right? So hopefully that video with the interview with them is going to come out next Sunday if all goes well. Do you have any burning questions that you want me to ask them? Let me know what they are in the comment section below, or simply go on the Facebook group or join our Facebook group, Passive Income Investing, to vote on which question you want asked the most, because I did a little survey a couple of weeks ago and I wasn't surprised to see that pretty much the hardest question for them to answer was the most popular one, which was, why did you recently lower your monthly distribution on ZWC, ZWK, and ZWP on the Europe one? So I can't wait to get all of their answers. Very exciting stuff. So thanks for watching, guys. Really appreciate it. Please hit that like button to show your appreciation. I would appreciate it. It takes 2 seconds and it helps the channel grow, so it's a win-win. Also, make sure you're subscribed because I have a lot more great content. I have more fund manager interviews coming up in the future. By the way, I have a couple of them lined up. Very exciting stuff. So subscribe if you like this content, especially if you're into investing for maximum passive income. That's all I talk about on this channel. So make sure you're subscribed. Also, don't forget to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the DIY investing package on version 3. It's version 3 right now. It's not very expensive and it comes with lifetime updates. So you only got to buy it once in order to get all the the new versions that will come out, because I'm planning on updating it at least once a year at the very minimum. So this is really a companion tool. It's a reference guide to help you build your own portfolio according to your investment needs. It's great for Canadians and for Americans as well. You got US listed funds there. You got sample portfolios as well for Canadians and Americans. So make sure to pick it up. Comes with lifetime updates. Also, I do offer a one-on-one consultation service with me personally via Zoom. If ever you want more personalized help, if you want to ask me a million questions, want me to analyze your financial situation, help you build a portfolio, give you advice, whatever it is. I do 4 to 5 of these a week. I love doing it. I meet people from all over the world actually, and it's very, very interesting. The problem is, well, it's not really a problem, but the thing is that the appointments sell out very, very quickly. It's in very high demand, and I only have about 4 slots a week. So just keep right there on the homepage, you see a little calendar. On top of the calendar, there's a message that will give you the latest status of the consultations, if they're open or closed. So I make the announcement when the new slots or the new appointments are going to be open via Facebook and via YouTube as well. So make sure you're subscribed and make sure you join our Facebook group not to miss the announcement, so you could snag an appointment when the announcement comes out. So that's pretty much it, guys. What do I leave you with? As usual, continue to stay safe, stay healthy, and of course, stay passive. See you next time.